A narrow window remains, and inside it, the final and strongest phase of the crypto bull run will unfold. Let's jump into the signals we track and trust, here at Glacium Research. The data we use to anticipate the upside, but more importantly, the same data we'll monitor closely to know when the cycle turns and when it's time to step away. Bitcoin doesn't move randomly. Look at this chart. Every major top happened exactly 4 years after the previous one. 2013, 2017, 2021. The same structure, again and again. And it's not just the tops. Even the bottoms follow the same 4-year pattern. Bottom in 2015, then 2019, then 2022. 4 years, 4 years, 4 years. No deviation, just perfect rhythm. Like clockwork. This isn't just about timing. Each cycle also brings similar drawdowns. Historically, Bitcoin drops around 75 to 80% from peak to bottom. It happened in 2014, again in 2018, then 2022. These aren't random. They're part of the rhythm. A full cycle comes with a full reset. Now look at where we are today, June 2025. And if the cycle holds like it always has, the next top would likely form around November 2025. And one indicator we track has predicted those tops with uncanny precision: the pi cycle. As you can see on this chart, every time the blue line crosses the purple line from below, it triggers a market top within 4 days, maximum. 2011, 2014, 2018, 2021. Now, the pattern is starting to take shape again, and if it holds, we should see a new crossover around November of this year, 6 months from now, signaling the top. The next bottom, for its part, just like in every past cycle, would likely follow 1 year later, November 2026. That gives us 6 months, 6 months before this cycle peaks, which means we are now entering the final and most explosive phase of the bull market. And we know how it always ends, with a bubble, driven by euphoria, excitement, and retail mania. The phase where narratives go parabolic, retail floods in, a wave of new retail buyers entering at the worst possible moment, providing the exit liquidity long-term holders wait for, every single time. And this next chart shows it perfectly. Here's what this chart tells us. Every time Bitcoin is in his last parabolic phase to create a top, we see the same pattern. Short-term holders, mostly retail investors, flood in chasing the rally. They buy aggressively often late, often near the peak. And who's selling to them? Long-term holders. Investors who bought earlier at lower prices quietly start to offload their positions into the strength, using retail demand as exit liquidity. And when both trends flip, from accumulation to distribution or the other way around, it typically signals the start or end of a cycle. And if you look closely, we've seen the same pattern begin to emerge at every local top of this bull cycle. We believe the final one will unfold within the 6-month window we're entering, creating the ultimate cycle top. That's why we're watching this very closely. This cycle did introduce some structural shifts that slightly impacted on-chain data, notably through ETFs, where some long-term holders moved their exposure, selling spot Bitcoin to re-enter via ETF format. Technically, it appears as selling, but in reality, it was more of a change in how they hold Bitcoin, not a true market exit. Every Bitcoin cycle ends the same way. We've seen it, time and time again. Retail investors rush in, buying late, buying fast, buying high, providing the exit liquidity that long-term holders need. And that's why tracking retail participation isn't optional, it's essential. Because without retail euphoria, a top can't form. So now that we've established the pattern, let's get precise, let's measure it, let's quantify how present retail really is, because that will tell us how close we are to the end. An easy way to do that is with Google Trends. It doesn't track price volume or volatility. It tracks attention, curiosity, the very first spark of public interest. Just look at this first chart, searches for cryptos. The peaks are obvious. 2021 was a frenzy. And today, we're still far below those highs. Retail interest hasn't come back in size, yet. Now look at this one, Binance. Same story. Search activity exploded in previous bull markets, but right now it's muted. Retail isn't piling in, not yet. And it continues. Bitcoin, Ethereum, Coinbase, altcoins. All follow the same pattern. Big surges during previous tops, but nothing comparable today. We're still early in the sentiment curve. Excitement hasn't reached the surface, and that's exactly what gives this market room to run. And we can cross-verify this using social media data. Start with Reddit. In every major cycle, we saw a surge in crypto subreddit subscribers. Bitcoin, Ethereum, the main crypto communities. Hundreds of thousands of new accounts every single week, all joining during the parabolic phase. But today, flat. No spike, no acceleration, retail hasn't arrived. Now look at Twitter. Here's the growth in weekly followers for major exchanges: Binance, Coinbase, Bybit. During the 2021 run-up, growth exploded. Same for Layer 1 projects like Solana, Ethereum, Avalanche, and for popular services like CoinMarketCap or Phantom Wallet. Each time retail floods in, we see the same pattern. Follower counts go vertical. But in 2025, still quiet, steady, but not euphoric. Even Wikipedia tells the story. Bitcoin broke above $100,000, but even mentions of Bitcoin on Twitter remain muted. No explosion in tweet volume, no wave of viral attention, nothing close to what we've seen in previous tops. The market may be climbing, but retail is still asleep. And that's exactly why the most explosive part of the cycle likely lies ahead. And we can even take it one step further. Let's look directly on-chain, into the blockchain itself, to observe how many retail wallets are actually active. This chart shows the number of active Bitcoin addresses. Historically, every major bull market peak came with a surge in activity, more addresses sending and receiving Bitcoin, a clear signal of mass adoption and mass speculation. But today, despite price-breaking new highs, activity remains muted. It's rising, but nowhere near previous bull cycle peaks. Another sign that retail hasn't fully joined yet. Now let's dig deeper. This chart isolates small transactions, under $10,000. These are mostly retail. And as you can see, during the previous peaks, 2021, 2017, they spiked hard, flooding the network with dumb money. But in 2025, nothing like it. No real spike, no parabolic demand. So what does it all mean? Price is rising, the cycle is advancing, but the crowd is still quiet. And based on everything we've seen, the crowd always arrives last, right before the top. Now let's look at volumes, because if there's one thing that confirms retail presence, it's trading activity. Let's start with exchange volumes, spot volumes across major platforms. Binance, Coinbase, Kraken remain well below previous cycle peaks. Yes, we've seen a recovery, but not the kind of blow-off top frenzy that usually marks the end of a bull market. Futures volumes tell the same story. Look at this chart. Bitcoin and Ethereum futures are rising, but still far from their 2021 levels. Even the total notional volume across all futures platforms, Binance, Bybit, OKX, is nowhere near the parabolic surges we've seen before. Same for daily volumes. They've picked up, but still remain relatively contained. This isn't euphoric panic buying yet. Not the kind of volume spikes that precede final cycle tops. Even quarterly data confirms it. Bitcoin's Q1 trade volume in 2025, higher than 2023, but still moderate compared to previous peaks. Momentum is building. But the true wave of retail speculation? Not yet here. And that's why this matters. Throughout history, volume always explodes before a top. Not just price, but participation. We're not there yet. And if we needed one last confirmation, just look at the funding rates. In 2017 and 2021, they exploded. Traders paying over 100% per year just to stay long. That's what peak euphoria looks like. But today, funding remains flat. Positive, yes, but modest. No leverage frenzy, no overheated market. The crowd is not here yet, and that gives us time. So far, we've seen a clear conclusion. Retail hasn't arrived yet, volumes are rising, but participation remains limited. Now, what if we could look ahead? What if there was a tool, a leading indicator, that could anticipate where Bitcoin might go next? Well, there is, and it's not on-chain. It's not in sentiment data. It's hidden in global liquidity. When we shift the global M2, the total amount of money circulating in major economies, by just 85 days, something incredible appears. A perfect correlation. Liquidity rises, and Bitcoin follows. Liquidity slows, and Bitcoin tops out. And right now, liquidity is still climbing, which means we can reasonably anticipate the next 3 months to be bullish. In late 2022, right after the downfall of FTX, Bitcoin found a bottom, and within 3 months, it was already up by over 50%. Then came March 2023. A wave of banking failures in the US sent shockwaves through the financial system. Once again, Bitcoin hit a local low and surged 55% in the following quarter. Fast forward to August 2023. when Evergrande's default added fuel to China's economic troubles. Bitcoin, same story, another bottom, followed by a 50% rally. Then, in August 2024, as the Japanese yen began unraveling and recession fears grew louder, Bitcoin dropped, before climbing 42% in just 3 months. What do all these moments have in common? Mass panic. And in every one of them, just as headlines screamed collapse, Bitcoin reversed sharply. In each case, it didn't just bounce, it broke out, surpassing its previous local highs by at least 20%. Recently, Trump reignited a trade war, this time with tariffs targeting nearly every major economy. But instead of selling off, Bitcoin bottomed just days after Liberation Day, and since then, already up 40%. If this pattern repeats and Bitcoin pushes 20% above its prior highs, we'd be looking at a move to around $130,000.